All right, let's jump straight into this explainer. We're unpacking exactly how a major home builder is battling some pretty massive macro headwinds right now. Today, we're looking at Green Brick Partners, breaking down their Q1 2026 earnings and seeing how they're navigating this incredibly complex housing landscape.
It really all boils down to this. How on earth does a home builder actually survive, let alone thrive, in a volatile 6% mortgage rate environment? That's exactly what we're answering today. For any builder, rates hovering around that 6% mark. It's like throwing a heavy brake on buyer enthusiasm, right? It totally scrambles the math for families, and it forces these companies to fundamentally rip up and rethink their playbooks.
Just to anchor ourselves with some hard numbers, Green Brick reported a massive $465 million in total revenue for Q1 2026, delivering 908 homes. Now sure, that revenue is down a bit, about 7.1% compared to last year, but honestly, delivering over 900 homes in a single quarter with these kinds of headwinds blowing, that is a serious operational feat.
So we're going to walk through this in 5 quick steps: the macro housing challenge, the margin squeeze and incentives, their pivot to the trophy brand, their land and mortgage strategies, and finally, the stock forecast and outlook.
All right, Section 1, the macro housing challenge.
To set the stage, the broader market is basically caught in a vice grip of high interest rates and tight affordability. As CEO James Brickman notes, they just aren't getting any relief on the interest rate front, and frankly, a weakening job market is only adding to those headwinds. Buyers are stressed out. They're feeling inflation at the grocery store, at the gas pump, and that economic anxiety directly hits their willingness to sign on a 30-year mortgage.
But here's what's really fascinating. The pain isn't evenly distributed. Look at this contrast. You've got strong demand at the high end, those luxury buyers over $900K, and at the entry level for homes under $350K. But that middle market, the $500,000 to $800,000 range, it is incredibly spotty right now. Management actually pointed out on the earnings call that uncertainty around immigration policies is causing high-earning professionals, the folks who usually snap up these mid-tier homes, to just sit on their hands and wait.
Moving on to Section 2, margin squeeze and incentives.
To keep sales moving, Green Brick is leaning heavily on buyer incentives. But before we look at the actual margins, we need to clear up a complex ASC 606 restatement they recently filed. Basically, they just reclassified how they account for closing cost incentives. It used to be logged as a cost, now it's a reduction in revenue. The big takeaway here? This accounting tweak has zero actual impact on their underlying cash flows, net income, or profitability. It's strictly an on-paper adjustment, so don't let it spook you.
So with that out of the way, here's the crucial point. Even with these discounts and incentives eating up over 10% of closing revenue, Green Brick is still pulling in an industry-leading 28.9% gross margin. Compare that to their land-light peers who are sitting around 15 to 16%. Because Green Brick's margins are so thick right out of the gate, they can easily absorb the cost of these discounts to push sales, while their competitors are frankly skating on much thinner ice.
And this quote from President Jed Dolson perfectly captures the environment we're in. Just a slight shift in mortgage rates can knock a full % off their gross margin. It shows you how incredibly sensitive profitability is to the macro economy right now. To actually secure buyers, Green Brick is using that fat margin buffer to buy down customer mortgage rates to around 4.99%. It's a calculated sacrifice, giving up a bit of margin to guarantee the sale.
Which brings us to Section 3, the trophy brand pivot.
Since they know that middle market is stalling out, they've pivoted incredibly hard toward where the demand is just screaming. Their entry-level brand, Trophy Signature Homes, has surged from 27% to 40% of their total backlog units, year over year. Guys, this isn't just some minor adjustment. It's a massive, deliberate rebalancing of their entire portfolio to chase that critical sub-350K buyer. And to capture those impatient buyers, they're intentionally holding about 1.5 months of completed spec inventory. In today's landscape, an entry-level buyer doesn't want to wait 6 months for a house to be built. They want a finished home right now. Plus, because Green Brick's buyers have excellent credit, averaging a 742 FICO score, the company is seeing a remarkably low 7.7% cancellation rate on these properties.
Trophy is absolutely their star performer here. It hits that urgent price point, and it does it with breakneck efficiency. Just look at this. They've optimized their operations so well that they're building these homes in Dallas in under 90 days. Because that turnaround is so fast, a staggering 75% of Green Brick's total lot allocation is now entirely dedicated to the Trophy brand.
All right, on to Section 4, land strategy and mortgages.
Beyond just the homes themselves, Green Brick's underlying corporate structure is really what insulates them from all this market volatility. Take their financing, for example. They launched Green Brick Mortgage, and its pre-tax income shot up 139% year over year in Q1. They're actually expecting a 70 to 80% capture rate by year-end. By financing the buyers in-house, they're grabbing a whole second revenue stream. In fact, management noted this will generate more pre-tax income this year than the interest costs on all the company's debt combined. Pretty incredible. Then there's how they handle their dirt. Look at how their lot strategy completely bucks the industry trend. While vulnerable landlight peers rely on really expensive, off-balance sheet land banking, Green Brick directly owns 77% of its massive 49,000 lot supply. They aren't paying sky-high capital costs just to hold land options. They actually own the dirt outright, giving them total pricing control and significantly lower direct costs.
And they backed us up with an absolute fortress of a balance sheet, featuring a microscopic 5.5% net home building debt to total capitalization ratio. Because their debt is almost non-existent, when premium master planned lots hit the market, Green Brick has the actual cash to just swoop in and buy them, while their highly leveraged competitors are stuck sitting on the sidelines.
And finally, Section 5, Stock Forecast and Outlook.
Let's synthesize all of this and look at the financial future. Analysts are actually projecting a near-term earnings dip this year, which makes sense as those mortgage buydowns and incentives compress their margins. But they're anticipating a solid rebound in 2027, with revenue climbing back above $2.2 billion. It's a classic story of taking a little near-term sacrifice to build long-term stability.
The big takeaway for the road ahead is that Green Brick is actively sacrificing some short-term profit so they can aggressively steal market share through this trophy brand expansion, especially targeting high-volume markets like Houston. And they're doing it all backed by a deep, 6-year lot supply pipeline and a massive $145 million cash pile to weather the storm. Which leaves us with a really fascinating question to chew on as this economic cycle unfolds. If rates stay elevated for the long haul, will builders who actually own their land and have the margins to offer deep discounts not just survive this era, but permanently squeeze out their competitors and totally own the market? Let me know what you think. Thanks for tuning into this explainer. And as always, keep questioning the data.